up another and it showed me two. I hope I've got the right one that's already in mobile. But anyway, we did about 45 last night before we got one more night. I was glad it's over. We can get a refile and get all the rejects done. So we'll still have food in probably a week after next week just for rejects. Robert had one last night we should have turned down. PITA is for low-income people, disabled, international students. But Robert got hold of one of our professors last night. He has capital gains, real income, and a bunch of things. I hate to turn anybody down, because it's a good experience for you all. It's a good experience for Robert. But the tax program is not as good to me as TurboTax. TurboTax would live Robert through middle income, capital gains losses. He wouldn't even have a question. But our tax program, we have questions. The one we use for IRS. And I don't think any unusual situation came up last night. It'd be the same old thing. We had a railroad retirement last night. And railroad retirement for any state is the same as Social Security. It's not taxable in that state. A railroad or Social Security, both retirement plans. But now, part of your Social Security may be taxable for federal. Part of your railroad retirement may be taxable for federal, but not for state. Somebody had workman's comp. What's the difference between workman's comp and unemployment comp? Workman's comp is for disability. You don't pay taxes on disability income. There was one lady that and her husband got workman's comp for 2 years. He couldn't get it, but he sued them and got a settlement for 30-some thousand. 30-some thousand minus lawyer fees, about 15, left him about, let's say, 20. But he had a 1099 on the whole thing. I don't think he should have paid taxes on the whole thing. Maybe neither. But now, since it was workman's comp, that's a disability, I don't think he should pay tax on any of it. So I told him, ignore it, not problem, that I deal with him later. He may have to pay taxes. Okay, but I may disagree with our rates sometimes. All right, unemployment comp, Robert, didn't used to be taxable at all. State of West Virginia pays a pretty good unemployment rate, now, $300-400 a week max or something like that, up to a year. Tracy, you drew on before, didn't you? Well, somebody here did. One was Georgia, we think they're employed. All right. So anyway, unemployment is taxed federal and state. State usually taxes you on everything that federal does, except Social Security and railroad retirement. And different states have a little bit different deductions, standard deductions. Different states, like West Virginia, gives a $2,000 for a teacher, which is public. They give a couple $1,000 for something else. They give the senior citizenship credit and homestead credit. So we just have to adapt to those changes. One more week. How many returns have you done, Caleb?
30, 31, something like that.
Sophie, how many? Olivia, you've done how many now?
9.
And Robert?
Well, if you give me whatever you said for costs,
4.
or it'll be like 36.
All right. Now, are you, the number of returns you reviewed, that I've got signatures for you, divide those by 2 and add it on. Now, how many do you have, Caleb?
49.
You got 49? Well, you're in good shape then.
Yeah.
You had to do 5 for class, and I think I reduced that to 40 for class, 40 for PITA, and 5 for class, 45. And I said, hey, you do over that, you got a point, a grade point on your final, on your final grade. Tracy, you've done how many? The Tracy did 10. She only needs 5 for class, and she gets a 5 point added on to her final grade. Now, how many have you done, Olivia?
45.
How many?
45.
Well, you're on the button, aren't you? And Robert?
Really don't know. Probably on. 10 or 12. How far we going?
Well, we got next week to get you to 45. Okay. If everybody makes an A, I'd like to give all A's. Okay. So, it's my class. I do what I want to. All A's may look fun. All A's are going to be easy class. No, it's not. You'll work for it. Now, Tracy, one other thing they get, I got a little letter yesterday, email from the lady who works for IRS. They will get a stipend. Somebody returned. Like Michael said he got $45, $50 last year. But every how many returns I turned in that you did, they'll give you, I don't know, maybe $1 return, I don't know. If I turn in 45, maybe you'll get $45. But, does any other class give you any money to take that class? You didn't have to buy a book, didn't have to study, didn't have a test, didn't have an exam, and you didn't start until February, and you're finishing up in the middle of April. And so, my bad, you'll get certificates from IRS, all of you will get that you've had experience, earned taxes. Okay. Now, Tracy, I will need I'll need all of your names and addresses. I'll send it in to IRS, and hopefully they'll give you I think you all signed that last night, didn't you? Kevin, did you? Just give me your name and address then, Tracy. Okay, that brings us up to date. I'm sure Michelle will be glad it's over. She's been doing the booking. And I do appreciate Sarah. She's volunteering. She's not getting paid as a student worker. I think I gave her 50. I'll give her at least another 50. But what's that, $10 a night? She's there 3 or 4 hours. But she likes doing it. So it gives her a little power or something. Some things she knows and she's good at. And anyway, but I appreciate Sarah. Okay, now back to class. We've got approximately 4 or 5 weeks. We've got to move on. Let's look at the chapter on corporations once again. That's chapter 2. I'm not concerned with chapter 1 whatsoever. Now, chapter 2, I haven't talked about it hardly at all. I've shown you how to do some calculation of taxes, and there's a section in here you've got to read. Now, we went over some advantages and disadvantages, and there's no need to beat those to death. We know there's advantage and disadvantage for a partnership, a corporation, and a sub-S, and a partnership. A sub-S, you have the advantage of being a corporation, but treated like a partner. Now, let's see now, what is a what am I trying to think of? LLC. What's an LLC? All right. Notice when you go home or wherever you're driving and you see an advertisement or sign out, Notice what kind of business. Is it LLC? Is it lawyer? Is it a CPA, an accountant, tax preparer? No, we think of most businesses as proprietorships or corporations. I hate partnerships, but anyway, and I like sub-S corporations if you're going to be a partner. But look at that LLC; it's getting popular. Come in, Giorgio. We just got finished talking bad about you, so you timed it just right. Okay, on page 9. Now, does anybody have, Walker, do you have a computer handy? All right, I do too, if it's connected to the internet. But will you type in State Corporation Commission, West Virginia? State Corporation Commission, West Virginia. What did it bring out?
It brings, business organization, West Virginia Secretary of State.
Business organization. Business wise. See if you have any ordinary incorporation paper. Does it have a search down there? Yeah, and incorporate, yeah. Small business. Okay. Right now, you can Google State Corporation Commission of West Virginia. Robert's trying to find another site, but somewhere on that site, you should find incorporation paper.
Articles of incorporation.
What?
Articles of incorporation.
Articles of incorporation?
I have them here.
Okay, let's see what you have. All right, now what you download these from?
On the website.
When?
It has a due date. It's like revised 12/2017
Right, well, when did you download this?
in December of 2017.
Did you do it for another client?
Yes.
Walter did it for Coach Hunter.
Yeah, Coach has
All right, if you want to start a business, then Coach Hunter teaches small business management, but here is the actual copy that Giorgio has. Now, pretty much it's got your name and address, location, county, mailing address, physical address is different, county is different. Now, that's just generic questions, and then you get down the website address, and the corporation is organized as a nonprofit or profit. The total value of all authorized capital stock, we know capital stock is common stock. And they were how many shares you want to authorize. And it would divide it into shares at par, put down the par value. And will the corporation elect to be organized for purpose as a benefit corporation for West Virginia, blah, blah, probably not. Is the business a scrap metal dealer? For nonprofit only. So you go on, you fill out these papers. Somewhere it's going to ask you the name and addresses of the incorporations. You must list at least one. Incorporator, that be you. Is organization a veteran-owned organization? And you get on down the number of acres of land, if you own any land, blah, blah. Does have the number of shares. This is different from the Virginia one. And you took it over here somewhere, we asked you what your product and what's the form of business. But, anyway, then you sign it. But I don't see the fee for incorporation.
Fees, not for profit is 25, for profit is 50.
For property is $50. That's cheap.
I think it's, no, it's 100 for profit, 25.
What's 100? Okay, I know nobody's going to do one of 70, state of Virginia. So, one original copy, two if you want a file copy, return to you. What is GTNMPED? Two, if you want a file blank copy, return to you. GTNMPED, not a word. Official state of West Virginia document, and I'm pretty sure they meant stamp. STAMPED, but they put GTNMPED on official state incorporation paper, state of West Virginia. Some idiot up there misspelled state. Okay. All right. Maybe that's what we're graduating around here. I hope not. Do you see that, Georgia?
Where?
You don't see what I'm talking about? Oh. Okay, so incorporate yourself if you ever want to incorporate. Legal requirements. You invest money. In most states, it can be $200 if you want it to be. Filing articles of incorporation, that's what Giorgio has over there. That's articles of incorporation. And issuing stock, paying incorporation fees. All right. If Giorgio wants to incorporate a business himself, he gives himself all the stock. He don't actually have to have certificates to hand out. But it's good to have stock certificates. If Giorgio and Kevin as a partner, they both own this corporation, they should get stock certificates showing that Giorgio has 100 shares and Kevin 100 shares. And in your corporation paper, says the par value of those shares, maybe what you all want to invest, $100 piece, $50 share, $10 share, whatever, you know. So I think I told you that Bill Gates set his stock at 1/10 of a penny, where a penny would buy 10 shares. All right. So a dollar would buy how many shares? If a penny buys 10, how much will a dollar buy? Nah, more than that. How much? 1,000. So if a penny buys 10, a dollar buys 1,000. And Bill Gates, for $10, had a lot of shares of stock. And his stock kept going up. Not to 1/10 of a penny a share, but to 90-some dollars a share. That's what made him the wealthiest man in the country, maybe the world at one time on paper. Okay. All right. Now, look at page 11, if you would. I believe that's the page I'm on. I'm not sure. Yeah. All right, I've always told you, if you start a corporation, just put in cash and take it from there. Start buying land, building, inventory, whatever you're going to do. But here on page 11, taxable property transferred. Now, overview of corporate forming rules. All right, you put in an item. Fair market value of stock received, money received, fair market value of taxable property transfer, if it's a taxable property transfer. But we'll get into this later so you'll understand it. We'll refer you back to this page. If you put in cash, you don't have a problem. If you start putting in equipment, what basis is the equipment? Your basis or the corporation's the day they got it? Did you have a gain when you transferred it, or you have a gain when the corporation sells it? So those are some of the things they're talking about here. And that's called section 351, page 12. I have asked you to read about section 351. Section 351 provides that transferors recognize no gain or loss when they transfer property to a corporation solely in exchange for the corporation's stock if immediately after the exchange, transferors in control of the corporation. So, Giorgio controls his corporation. He's one owner. So he transfers his vehicle. According to that first sentence, is he taxed or not taxed on that vehicle? No.
But it's deferred. It says it's deferred.
It's deferred.
Well, you pay taxes later if you sell the stock.
Right. It's deferred. Now, fair market value of this vehicle is $15,000, and he gets that much stock. What value is he putting on the stock? Okay.
15,000.
Yeah, 15,000 stock.
Fair market value of the vehicle will be the basis of the stock.
Right. It'd be the basis of the vehicle too. Okay. Whatever the corporation paid. So, but what makes it more complicated? He had this vehicle, we say paid 30 for it. He kept it 5 years, and it's worth 15, really. Or fair market value is 15. If he sells that on a personal basis, I don't see anybody should recognize a gain or loss, because you do not have a gain if you keep a personal vehicle long. You have a loss, which is not deductible anywhere. We're reading on down here, looking at a couple other things. Section 351 does not apply to transfer of property to an investment company, nor does it apply in certain bankruptcy cases. All right, so Giorgio transfers this vehicle. Let's say it was a business vehicle. Its basis was 10, and he gets $15,000 worth of stock in an investment company. That he's got $5,000 realized and recognized gain. That's all this first paragraph is showing. All right, well, what Giorgio was talking about there later, always look at your examples, 211. All right, the specific requirements for deferral of gain and loss under section 351 are, here is 3 bullets. The transferor must transfer property to corporation. That's what Giorgio was doing. They must receive stock. That's what Giorgio wants, stock. They must be in control of the corporation. And that's what Giorgio is. So there's your 3 rules again in the form of bullets at the bottom of page 12, and you will need to know those. Now they tell you the property requirement, control requirement, I would think would be 51%.
80%.
But they say 80. On page 13, the control requirement. The transferor may be an individual on any type of entry, such as a partnership, another corporation, or a trust. Control is the ownership of at least 80%. So Giorgio has to own 80% of the corporation, not 51 or 2. 51%, you run it because you got all the voting power. Now, if you transfer services, usually that has no basis one way or the other, but do read about it. All right, look at page 16. Under section 351, the stock requirement, all right, the transferors who exchange property solely for transferee corporation qualified stock recognize no gain or loss. Well, we're saying the same thing. And here's 3 bullets again. The shareholder can require the corporation to redeem it. The corporation either is required to redeem the stock or is likely to exercise a right. The dividend rate on the stock varies with the interest rates. That depends if it's preferred or not. But read that little paragraph too. And you don't have to elect that section 351. George,
What exactly is a boot? It
what?
says that preferred stock will be treated as a boot. What's a boot?
As a boot?
Yeah.
B-O-O-T?
Yes.
Well, all right. You've got a vehicle that's worth 11,000, and you trade it to Kevin. His is only worth 9. Do you want to trade even? Do you want to give Kevin a $11,000 vehicle for a 9? So what if Kevin gives you 2,000 to make up the difference? Is that okay? Then that's boot. Does that make sense?
Yeah.
Okay. All right. Those asset things, they get very complicated. I just want you to read it again. We'll look at some problems on it. You need to read the rules on it, and who pays the gain, who pays the loss. But I am more concerned with us doing a corporate return. Now, I want you to bring in 1120 on Tuesday. Make sure you bring in 1120. That's a corporate return. It's probably 5 pages. I'm going to give you a problem where if you do the front and income statement. Page 2, you probably just answer questions. Page 5 was probably cost of goods sold. We have it. Now, page 3 and 4 is a balance sheet and something similar to a retained earnings statement and reconciling your book income with your taxable income.
What's the name of the form?
1120. Picture show of 1, maybe 2. And somebody print off an extra in case Giorgio forgets. All right. Now, we're going to go over a corporate return. A lot of this information is good if you get into high-powered corporations, whereas the owners transfer a bunch of assets. All you got to do is know who owns those assets, who realizes gain or loss, and that's what this complicated language is trying to tell you. Okay? We know about assuming liability, it's the same as cash. And there's other examples. So read that section 351 once again, okay? Now look at page 27. Read that bold print at the bottom. What does it say? Choice of capital structure. How's a corporation get investors? Stockholders? Okay, if they sell stock, that's all right. How else does a corporation get their operating money, capital, cash? Debt. Now, let's think of a cash flow statement. A corporation has operating income. Then a corporation has investments. They'll buy land, sell land, buy equipment, sell equipment. Maybe invest in stocks and bonds. Maybe give them a long-term notes receivable they get interest on. That's under investment. And you get down on the financing, you only had 2 ways of what were stocks or debt. Debt is in the form of bonds or a long-term liability, which would be a note payable. So you got debt and stock. That's the way you Well, that's the capital structure of an organization. Debt and stock. Right now on page 28, they give you some ideals on debt, capital, and debt and equity. Let me sum up these two pages for you. Let me sum up page 28 and 29. All right. If a corporation issues equity, which is page 29, they pay out a dividend, right? Right? Now that dividend is taxable to the shareholder, but the corporation cannot take a deduction. Now on the debt on the left page, page 28, if you pay bond interest expense, it's a deduction for the corporation. But there's some other advantages and disadvantages. You don't have to pay a dividend if you don't have it. Unless it's cumulative preferred. You don't pay it now, you pay it later. Cumulative preferred dividend. Now, an interest payment on a bond comes due every 6 months, whether you got the money or not, you got to pay interest, even if you have to borrow. You're going to be in default. So there's advantages of both. If you issue equity stock, you've got more ownership out there. There's 4 owners, now you may be 7 owners because you sold stock to 3 more people. So you could be losing control of the corporation. So on these 2 pages, somewhere should be most of those comments. Okay. Again, you don't have to pay a dividend. Now, when you look at this corporate return, dividends is a big page. Now, if a corporation wholly owns another corporation, this corporation, Y, pays A corporation dividends. Now, if A corporation had to pay taxes on those dividends, then they give you a shareholder dividends, then you got to pay. See, those dividends can be taxed 3 times. That's why you have a whole page on 1120 to check off if it's a wholly owned domestic corporation or if it's just any other corporation. You may get it up 60, 80, or up to 100% of the dividends on a corporate return. Because when you give your stockholders dividends, they're going to pay taxes on it. Okay. Now, the corporate rate, we've got those in the back of your book. They go up to 39%. Under Trump's laws, they're cut down to how much? Under Trump laws, they're cut down to 21%. Come on, one of y'all looked that up 2 weeks ago. It was 21%. Okay. You all are the ones getting all high. I should be, but you all are getting it for me. Okay? All right. So that is equity capital and debt capital. Know the reasons for either one of them. And you can look at page 30, tax advantage and disadvantage of using equity in a corporate capital structure. Using equity, that's selling stock. Look at the advantages. The 70, 80, 100% dividend received deduction is available. A shareholder can receive common and preferred stock in exchange, no cash dividends. All right. Under section 1244, common or preferred stock that the shareholder sells or exchange so becomes worthless is eligible for an ordinary loss. All right. Qualified dividends are taxed at the applicable capital gains rate. So that's dividends for you. That's just the advantages. Look over the disadvantages. All right, worthless of stock or debt securities. I want want you to look at example C2-46. And let me make a comment about what's happened on these 2 pages. For $175,000, Tammy and her husband, Co., purchased 25% of Minor Corporation initial offering of a single class of stock. Minor is a small business corporation, and the minor stock satisfies Section 1244, which is small business. On September of the current year, Minor filed for bankruptcy. 2 years later, the bankruptcy court notified shareholders that the minor stock is worthless. In that year, Tammy and Co. can deduct $100,000 of their initial investment as ordinary loss. The remaining is treated as a capital in character. Now, so you lose $175,000. Now, if that's a long-term capital gain loss, how much can you take a year? $3,000. So they're trying to do better than that by you. If it's a small business corporation, they're letting you deduct how much of it in the year of the loss as ordinary loss. 100 for married, filing joint, 50%. That's a pretty good deal. If you had W-2 wages of a couple $100,000, you'll get a lot of tax refund. What?
Where is that?
It's on 232, that third bullet under security.
All right. But I want you to back up a page. I want you to find out about however how many pages it takes in section. Can you find that section of stock, which is section 1244? All right, now look at page 32. Yeah, look at the third bullet, section 1244 stock. That's what Tracy was pointing out to Giorgio. But I want something more than that. That sounds good, but what is section 1244 stock? It's
Worthless?
huh?
Worthless?
No, but what is it? If it becomes worthless, you do get to take 100 if you're married, filing joint. But what is it? I'll tell you what it is. It's small business stock. But I wanted the definition of small business for IRS. Is it under $1 million a year in revenue or under $5 million? They change these figures every year, so I don't plan to remember.
Less than 100 employees. Less than 100 employees.
If you have less than 100 employees, you're considered a small business? Did you read that?
Yes.
Where?
A small business corporation is a corporation that receives in the aggregate 1 million or less in money or non-cash property in exchange for the stock.
So they receive $1 million or less for stock. But first of all, that is the million I guess I'm thinking about. But does the earnings have anything to determine whether it's small business or not? It just used to be earnings. Is it stock now?
The issuing corporation must have derived more than 50% of its aggregate gross receipts from active sources during the most 5 recent tax years ending before the date on which the shareholder sells or exchanges the stock.
Well, say what amount, right? But you gotta know that it's bankrupt. Gotta be bankrupt. I had bought some penny stock. It was Impro, some company, electronic company formed in Tazewell. And I didn't look into this law at the time, but I think I only had a couple thousand invested. I lost it, so I had to take it all off this long-term capital gain loss anyway. It was not over 3,000. But had I lost 10 or 20,000, this rule would have helped me, wouldn't it? I could have deducted it all as ordinary loss. Ordinary loss is better because you deduct it all instead of a limit of 3,000. Ordinary gain is bad because you pay maybe whatever your tax rate is, 25, 30%. But a capital gain, you only pay 15%. Capital gain is better. All right. but ordinary loss is better. Okay, see if we can talk about a. Right now on page 34, avoid section 351. Well, I can tell you easy how to avoid. Just put cash into the company and start your company. Go out and buy your assets. Don't put in assets and you avoid 351. But here they say it's not an elective provision. If its conditions are met, a corporation formation is tax-free when you form it, even if the taxpayer does not want it to be. Most often, taxpayers desire 351 treatment because it allows them to defer gains when transferring appreciated property to a corporation. In some cases, however, shareholders find such treatment disadvantageous. All right. Avoid it, put in cash. Page 35, please read all those bullets on how to avoid gain under section 351. First bullet, if the transferor's gain is capital in character, he or she can offset the gain with capital losses from other transactions. So read those bullets. All right. Now, where is there 1120? I want you to look at 1120 again on what page? Is there not one at the end of this chapter?
One on B.
Was B what?
B50.
B50?
52.
Well, I am there, I think. Another mine tore out. No, that's good stuff. Well, I took them out. Okay. All right. Once again, this is an income statement. I told you how to be careful on officer salary. Don't double deduct officer salary. Don't put it into salary expense and officer salary. It would double count. All right? Officer salary, be careful. All right, now page, let me look at the next page of this thing. Page 4 here, I'm on page 4. Page 3, page 2. All right, now page 2 is your Schedule C, is your dividend and special deduction. Deduction from less than 20% on. And you can see that from 70, 80, it can go down to 42 or 100% excluded. But page 2, you'll probably have an entry to on page 2. Okay. Now page 3. Okay, page 3, Schedule J. That is computing your taxes. All right. If you look at this, income tax, $10,593. That's what you owe. Now, the corporation can pay estimated taxes. There should be a line on here for estimated taxes. And you see that line. They get some foreign tax credit, general business credit, credit for prior year minimum tax, on credit. You don't have to worry about those credits.
Line 13.
Okay, it's way down in part 2 then, payments refund. So you find your total tax on line 11, line 13 is your estimated tax payment. Or if you had an overpayment from last year applied to this year. So that is your tax calculation, part J. Excuse me, what's part K? That is your officer information. Like you know your business, your activity, manufacturing, what's your product, furniture. I had an interesting situation just about an hour ago. Somebody wanted their tax return done by one of our students. And they said they heard something the student was saying that now they don't want to get this student to do their taxes. They overheard that student saying that her husband was in manufacturing business. And she heard the word illegal drugs. So she didn't want somebody to do her tax return if their husband was in the manufacturing business. Manufacturing business would probably be meth, wouldn't it? Guess you make meth. So, anyhow, it was not one of yours, I wouldn't be telling. Good. All right, now, before we get to page 4, there's an attachment page, which is 1125-A, and that is your cost of goods sold. That used to be part of a 4-page corporation return. I don't know why they changed it. All right. Now, there is a K on page 4. There is a K. The K is pretty easy. Usually you just have to answer yes or no questions. All right. And we have a schedule L. I noticed Jessica or somebody last night asked some questions. When y'all get down to a certain part on that tax program, does it ask every time, what other languages you speak?
Yeah.
Wonder who's collecting that information. Well, Giorgio was in Costa County. He graduates this year. Not Giorgio, but Lorenzo. And he's thinking about going to Denmark to get a higher level business degree, equivalent to a master's or something. And he said if you were living in any country in Europe, you went to this university free. Now, you're considered Europe, aren't you? Yes. All right. Now, how about universities in your country? Could somebody from Italy go to a university in your country free?
Yeah, we have some foreign students.
Do they go free?
I think they get full scholarship. I'm not sure.
That'd be free?
That'd be free.
Okay. Well, I know you're here on 10 scholarship, but is it 100% free, everything? You have to pay for some things, don't you? But that's a pretty good deal, because university lets any student from the countries in Europe go there free. Now, the only people who go free to Bluefield State is an employee's children. Michelle Copeland downstairs, she ain't here free because her mother teaches nursing. Okay, now her mother is a dean. So Michelle was on this campus before she was born. All right. So now her new baby that's going to arrive in the fall, it's been on this campus before it's born. So she's carrying on the tradition. I told her that the other day. I said, so you were on this case before you were born? She said, I hadn't thought about that. I guess I was. Okay, now the important page is page 5. This can give you trouble. Now, there's a couple of things I want to mention here that you haven't heard of. I want you to look at assets. Now, look at 2. You know what that is, trade notes. Be notes receivable, inventories. But now how about number 4? That's an asset, U.S. government obligations. You've got T-bills for the United States government. You may have bonds. Tax exempt securities. You may have municipal bonds. I want you to look at line 7. What is that?
Loans to share.
Is that an asset or a liability?
It says it's an asset.
Loan to shareholders is an asset. You might as well say notes receivable from shareholders, right? That's what a loan is to a shareholder.
U.S. government obligations. What was the,
Which number?
line 4.
U.S. government obligation. All right, if I own a U.S. government bond, that's an obligation of the government to pay me. It's an asset.
Oh, interest.
Yeah. Or if they own T-bills. Okay, I want you to get straight on line 7, loans to shareholders. Okay, so, Jordell, if you own even 40% of a company, you might go to that corporation and say, you need to borrow $10,000. That corporation may loan you $10,000. So, instead of calling it notes receivable, they call it loans. It could be loans to shareholders receivable. Now, I want you to look at the other part of that. Look at line 19. What does line 19 say? Loans from shareholders, right? So your corporation needs money. They may borrow $10,000 from you. That's almost like loans payable to shareholders. So keep in mind, 7 is a receivable and 19 is a payable if you come across it. I came across one corporate return that had that on it. Somebody prepared it before. The owners of the corporation couldn't explain why they had loans to shareholders of $30,000. So I wiggled a return around in a year or two that they were paid back this loan, and I got it off the books, okay? All right, balance sheet. You gotta have last year's balance sheet and this year's balance sheet. Now, if it's a new corporation, obviously you can only have line C and D, right? Column C and D. It has to be an old corporation to have columns A, B, C, D. Okay, now we're down to M1. Reconcile book income. Now, I've mentioned this before, slightly. Net income per books does not have to match your taxable income. And it won't match your taxable income. First of all, whatever your taxes is, you take out. If my net income is 63 and my taxes is 14, then I only have about 49,000 something of income that would go into retained earnings. If it's 63, cannot go into retained earnings. But 63 minus 14 can't go into retained earnings. All right, but on down here, expenses recorded on books this year, not deducted on the tax return. Depreciation. We may have taken double declining balance as the old method or some here digit. Not allowed. So we take MOECRS. So we deducted book income will gain on taxes. Charitable donations. A corporation can take 10% of their net income. If net income was 100,000, you could donate 10. Anything over that's a carry.
Net income before taxes or
I think it's net income before tax. Well, we can find that out real quick. It should be on the front of the form itself. All right. Look at line 19 on the front of your tax form. What does line 19 say?
charitable contributions.
All right. You are limited to 10%. This may be less than 10, you don't have a problem. But taxable income was 63,000. 10% of 63,000 only be 6,300. So where am I off here? All right, it's 10% of taxable income before charitable donation. So add this 7694 back to 63,073. See what that gives you. Add 19 and line 28 together, please. Have I got a calculator doing that?
We have 19 and what?
19 and 28.
7,767.
What?
7,767.
I'll take 10% of that.
76.
70,000 what?
76.
All right, well, I need 7,694 from somewhere. I need 7,694. There must be some other deduction too. There'll be something else we don't pay. We'll go back and read that part on charitable donations, okay? There should be 10%, of line 28 before charitable donation. I'm sure there's got to be something else here. I can't spot it right now. So let's move on to Schedule M1, manufacturer non-deductible interest. That could be interest. You borrowed money to buy a municipal bond. So line 6, 87,718. Now is what you're ending up with taxable income. Line 7, income recorded on the books this year, not included on tax return. Tax exempt interest, for example. All right, deductions on the return not charged against book income. Appreciation and U.S. production. These two lines do not have to match. Line 8, 6, and 10 do not have to match. All right. Then analysis of unappropriated retained earnings. Well, we got to find out what our net income was first. But retained earnings was 97.8 at the beginning of the year. We're going to add net income per book 63,412. We're going to add net income per book. I wonder federal income tax per book if it was taken out first. All right, that would give you 161,000 retained earnings. If you paid out dividends, that leaves you 133. So that 63,000 must be after you took out federal income tax. So we got to work with these. This back of this form is the hardest. We will work with it. That's why I bring a blank form to class. Now, unless you do a couple of problems too over the weekend. This is the most important chapter on corporations. And all right, I want you to do some specific problems this time, please. Do problem 34. All right, do property 43, a problem. Now, that's just short answer stuff. Now, I want you to start putting on. They don't have what I want yet. I guess do problem 57, but we do not have a corporate problem yet. but we will have after chapter 3. That's why I want you to bring those forms. Okay, it's Thursday, the end of the week for some of you, and I've got some advisees coming by, so I'm gonna let you go. And, you know, I don't know if I started hanging out near this period, this thing had messed up. So I might not have a thing